Hello, good morning. Jayaram here. Welcome to Almus Market Morning. Fresh fears on Omicron variant of COVID weighed on the US and European markets after Boris Johnson warned of a tidal wave of new cases, possibly causing one person's death also. WHO also said variant poses a very high global risk, with some evidence that it evades vaccine protection. There have also been jitters ahead of Fed meeting, which could throw up a dot plot which is much more hawkish than previously seen. While ECB is likely to announce an end to its PPP program in March, some indications are that it may be replaced by another scheme that keeps the euro subdued and helps the dollar to be strong. For sterling, apart from the Omicron mentioned earlier, expectation of a rate hike in this week's meeting have been pulled back, although strong job numbers and inflation tomorrow can change the picture slightly. Political issues are also coming into fore at UK, with many petty scandals being talked about. Bank of England's Bailey says there's a lot of news still to come on Omicron. So overall, good news is missing from UK, and markets are again getting bearish on the pound, although it is hanging on to that support at 1.32. While a lot of good news for the dollar have been priced into the current level of dollar index, other countries do not have any positive news that would help their currencies. Thus, dollar is actually remaining strong by default. If the Fed forecasts inflation above 3% for 2022, or if 2023 projection jumps, then actually the dollar bulls will just get into a stampede. We will have PPI data today with month-on-month showing some moderation, while year-on-year will be on the higher side. On the data front, yesterday, there was no major numbers except the New York Fed survey, which showed one-year inflation expectations increasing to 6% from 5.7% on the previous month. Overall, we are seeing a yo-yo in the stock markets, moving in a wide range, but certain amount of bearish bias is developing as the news on either front, be it on the COVID or on the monetary policy side, or supportive of fresh risk on trades. On the Indian side, there was a CPI number yesterday that came lower than expected, but higher than last month's at 4.91. Main push coming from food prices. The low numbers may be getting help from the base effect last year, which will recede in the coming months and show up in higher inflation number. At least for now, though, these numbers help central bank to prioritize growth and maintain policy rates steady. Going forward, factors to watch will be the impact of excess duty cut on fuels, fall in global crude prices, volatility in the food prices, and the telecom tariff hikes. Question only remains whether global supply chain constraints will ease to have a more lasting positive influence on inflation. That is a big if, as we contend with the new COVID variant. USDINR is now in a slow grinding weakening path with a lot of selling absorbed, and the way is clear for a test of 76 psychological level if we get through 75.85. An abrupt end to stock recovery yesterday combined with FII selling is likely to sour the mood today. In any case, technically, close above 75.50 yesterday is a positive development for the USD. We remain bearishly biased for the rupee in the short term. Thank you.